So with all the news about ASML lately, I wanted to talk about something bigger. Something about this whole AI frenzy. It feels like the market has all of its attention, right up front. We're all looking at the large models, we're looking at NVIDIA, all the AI infrastructure. These are the stars of the show, right?
And that makes sense. It's where all the excitement is. It's where the growth feels most explosive and visible.
But what if we're looking in the wrong place? What if the real thing, what's going to limit how fast AI can grow, isn't up there at the top, but way down at the very bottom? I'm talking about the foundational manufacturing layer, the part that decides if we can even make enough advanced chips to keep this whole thing going.
And if that's true, if that foundational layer is what really matters, well, then a company like ASML, and the way we value it, it might be time to pull it out and take a completely fresh look.
And this, I think, gets us right to the heart of the matter for anyone investing in this space.
So what is ASML's true identity right now? Is it still just a classic equipment company? The old view, it's tied to cycles, we judge it on quarterly orders, its value goes up and down with semiconductor spending. Or has its position fundamentally changed in the AI era? Is it now something more like a strategic monopoly, a foundational bottleneck whose value isn't about cycles, but about being completely irreplaceable?
And here's why I've been thinking more and more about that second option. Lately, even a company like Tesla, a company that lives at the very top, the kind that soaks up all the attention, even they are starting to look down at the underlying chip manufacturing capabilities.
And that's a huge tell. It suggests that the most hyped-up layer of the market, it might not be the most critical one for future growth. The real constraint, the thing that determines that this AI build-out can continue, might be shifting to that deeper manufacturing layer.
And if that's what's happening, if the bottleneck is moving from designing chips to actually producing them, then for us as investors, the whole question changes.
The problem we need to be thinking about might not be who has the best design, but who controls the lithography bottleneck. If the entire AI expansion is physically constrained by the limited availability of this one type of equipment, while the company that owns that bottleneck is in a very, very different position.
And let's be crystal clear about what we mean by bottleneck. This isn't a competitive market where ASML has a nice lead. For the EUV lithography that is absolutely essential for every single advanced AI chip, ASML's market share is 100%, not 90, 100.
So the question for us is no longer, is ASML important? That's obvious. The real question is the market still valuing ASML like a regular cyclical equipment company? Is it still using the old rulebook to price a company whose position might have fundamentally changed?
And this is where it gets really fascinating, because I think there might be a lag here, a gap between the reality of ASML's new position and how the market perceives it.
The market has habits, right? For a company like ASML, we're all used to looking at it through these old frameworks. We watch the equipment cycles, we get nervous about quarterly order volatility, we track semiconductor capex. That's just how we've always done it.
But if the true constraint for AI is now this foundational manufacturing piece, then it's possible the market is giving ASML the price for its old identity, not its new one.
And this is the core of what we're discussing right now. ASML's actual position in the world may have changed, but the market's perception, its way of looking at the company, it might not have fully caught up yet.
So if you're an investor, the next question isn't just, is ASML a good company? It's, is this a company that's about to be repriced by the market? Because a real revaluation, it comes from the market slowly waking up to a new reality.
And that process usually follows a pattern. You have a big catalyst, like this AI surge, that highlights a bottleneck. Then awareness slowly starts to shift. The story, the narrative around the company, changes from words like cyclical and volatile to scarce and indispensable. And that's when you see the valuation multiple itself begin to permanently move higher.
When that happens, the whole conversation shifts. We stop obsessing over near-term earnings and start focusing on the long-term value of its unique, unshakable position. We're not just talking about earnings elasticity anymore, we're talking about the valuation floor itself.
So, if you follow this line of thinking, my own feeling is that it's at least time to give ASML a serious second look. It might not transform into a completely different type of company overnight, but its role in this AI expansion, it's just not the same old role we're used to. The discussion, I think, has to shift from trying to time the cycle to trying to value its positional scarcity. And once the broader market really starts to believe that foundational manufacturing is the true bottleneck, the entire valuation debate for ASML is going to change. It's really just a matter of when.
So should ASML be reevaluated?
My view is that the discussion should already be on the table.
Because the truly interesting question right now isn't about this quarter's earnings report. It's about whether the market will slowly accept that ASML's position in the AI era is just different. Is it still a typical equipment company just catching a nice tailwind from AI? Or has it moved into a much rarer, much more strategic position that justifies a whole new price?
I think that's the question worth seriously debating right now. But what do you think? Is ASML still running on the old logic, or has a new logic already started to take hold? Let's discuss. And of course, remember, this is all for discussion and informational purposes. It's not investment advice, so please do your own research and consult with a professional.